Let's start!
Active investing refers to making frequent buy and sell decisions with the goal of beating the market. Meanwhile, passive investing focuses on matching the market performance by buying and holding index-based investment for long term. In simple terms, active try to outperform the market while passive try to follow the market. For the characteristic, active investing is hands-on. It requires constant monitoring of market news, stock price, and economic changes. It usually involves higher fees because fund managers actively trade. The strategy has the potential for higher return, but it also comes with higher risk. So how it works? Active investors make decisions based on research, prediction, and market trends. They try to buy undervalued stock and sell overvalued ones. The main aim is to beat a benchmark index like the S&P 500. Example include stock picking, active mutual funds, and hedge fund. For the characteristic passive investing, on the other hand, is a long-term, low-maintenance approach. Investors buy index fund or ETF that track major market. It has much lower fees, offers wide diversification, and provide more stable return over time. So how it works? In passive investing, the investor simply buys an index fund that mirrors the performance of a market index. There is very little trading involved. Investors hold this fund for many years, letting the market grow over time. This strategy is ideal for beginners or anyone who prefer a simple, steady approach. Now, let's look at the key differences between active and passive investing. This table summarizes their main characteristics side by side. First, the goal. Active investing aims to beat the market average. Investors try to outperform the index by choosing specific stock or timing the market. Passive investing, on the other hand, aims to match the market performance. The objective is not to beat the index, but to follow it closely. Next is strategy. Active investors frequently buy and sell security to make advantage of short-term opportunity. Passive investors simply buy and hold a diversified portfolio that tracks an index, such as the S&P 500 or MSCI World. Next, for the management, active investing is handled by a portfolio manager or investor who consistently does research and makes decisions. Passive investing mostly runs on algorithms that replicate an index, so it requires minimal oversight. For the cost, active funds usually have higher fee because you are paying for research, management, and frequent transactions. Passive funds have much lower fee since they require less management and fewer trades. For the risk, active investing carries higher risk. If the manager makes the wrong decision or mistime the market, return can suffer. But if done well, there's potential for higher gain. Passive investing has lower risk because it follows the overall market, although the investor is still exposed to market downturn. Active investing is more suitable for investors who seek higher return, can accept higher risk, and are willing to pay higher fee. Passive investing is best for people who want steady long-term growth, lower costs, and less involvement. For the tax consideration, active strategy involves frequent trading, which may trigger more capital gains tax and increase overall transaction costs. Passive strategy involves fewer trades, which generally leads to better tax efficiency and lower trading expenses. So, overall, the key differences revolve around cost, risk, management style, and how hands-on the investor wants to be.
Active investing and passive investing are two different approaches to growing wealth, and each has its own advantages and drawbacks. Active investing involves fund managers or investors who constantly study the market and make frequent buy and sell decisions to try to beat the market. The main benefits of this approach include the potential for higher returns, flexibility to react quickly during market changes, and the chance to take advantage of short-term opportunities. Active strategies can also be adjusted anytime based on new information. However, active investing also has several weaknesses. It usually comes with higher fees because of frequent transactions, and many active funds still fail to outperform the market consistently. There is also the risk of poor timing when trying to buy or sell at the right moment, and investors may make emotional decisions during stressful market conditions. Passive investing, on the other hand, is a simpler strategy that focuses on tracking a market index rather than trying to outperform it. Its key advantages include low fees, better tax efficiency, and easy diversification since index funds automatically spread investments across many companies. Passive investing also offers more predictable performance because it follows the overall market, Still, it has some limitations. Passive investors cannot react quickly to market downturns or take advantage of short-term opportunities, and their returns will fall whenever the overall market falls. They also cannot choose specific stock to include or exclude, and they may miss out on bigger gains during strong bull markets. In summary, active investing offers flexibility and the possibility of higher returns, but comes with higher costs and more risk. Passive investing, cheaper, easier and more stable, but it limits control and usually cannot beat the market. Choosing between the two depends on an investor's time, risk tolerance and investment goals.
Let's move forward to active and passive investing illustrations that happen in the real world. We need a possible example to illustrate this mechanism better. But before that, which return is higher, active or passive investing? What will you do if you have $10,000? First, we refer to MSFT for Microsoft stocks for active investing. This is where we could check the total return by the time frame date. Let's say we're using 10-year references, it shows in the red circle with 931%. Let's take the amount of $10,000 we have before a startup and start around 29 November 2015 since we use 10-year references that would reflect the amount in 2025 later. We put this amount here, and the return recorded for that period is where we refer from the previous website. We need to see the growth factor, so put the total return we obtained into the formula and get the amount. Lastly, we add the growth factor with the initial investment to get the final value. We will get 10 years later in 2025 amounted as $103,100. Next, let's see S&P 500 company for passive investing. Here is also the simplest where we refer to the return amount. Same as previous example in MSFT, we put the 10,000 around 29 November 2015. After we get the growth factor value, we add it with the initial investment to get the final value, which is $29,154. Through the findings, we could see investing in MSFT as active investing will give us a higher total return because of the strong performance as cloud, AI, and enterprise services, but lower in S&P 500. However, S&P is growing slower but more stable and diversified.
When active investing combined with passive investing, it will create a hybrid strategy. Usually, the passive part becomes the foundation and the active part is used to grab extra opportunities. The benefits that investors can get when using hybrid strategy is first, more balanced risk. With cost efficiency and broad market exposure, it can balance the potential for market outperformance. Passive investing gives stability, while active investing reacts faster to market changes. Number 2, potential for high returns. Investors can get high return if the active portion performs well. It adds extra growth on top of the passive piece. Number 3 is diversification. Investors get broad market exposure from passive funds and targeted exposure from active funds. It also allows an investors to leverage the benefits of both styles rather than choosing one over the other. However, you need to remember that mixed portfolios also need more monitoring because the active part might require adjustment. And if the active picks underperform, your returns can drop.
Next is, which does our group prefer and why? So, our group prefers passive investing because it offers a lower cost, lower risk, and long-term growth approach that aligns well with most investors' financial goals. Passive investing does not require constant monitoring or trading decisions, which makes it more stable and less stressful for beginners and long-term investors. Furthermore, passive strategies such as index fund or ETF provide broad diversification, helping to reduce the impact of poor performing stock on the overall portfolio. It also offers better tax efficiency and predictable returns since it tracks the market index rather than trying to beat it. Although active investing can sometimes generate higher returns, it involves higher fees, more time, and greater risk due to market timing and human errors. Therefore, our group believes that passive investing is the most practical and sustainable strategy for achieving consistent returns over time.